Energy Fuels, ticker symbol UU, is crashing. The stock has dropped hard in recent weeks, and investors are starting to panic. But here's the real question. Is this just a classic overreaction from a jittery market, or a once-in-a-while opportunity to grab a future energy leader at a steep discount? If you're unfamiliar, Energy Fuels isn't just another speculative mining stock. It's a critical USA-based player in both uranium and rare earth elements, two resources essential to clean energy and national defense. And yet, despite its strategic importance, the stock is tumbling. So what's going on? Was it a weak earnings report, a shift in uranium pricing, geopolitical noise, or is investor sentiment just turning sour on junior miners? More importantly, is this dip the beginning of a longer decline or the kind of setup that seasoned contrarians dream about? Before we break it all down, make sure to subscribe to Stocks Telegraph for sharp, data-driven stock analysis and breakout investing opportunities. And drop your take in the comments below. Are you buying the Energy Fuels dip, or are you staying far away from this falling knife? Energy Fuels has recently seen a sharp drop, falling roughly 14.6% over the past month, from $4.45 to $3.45. The broader uranium market has also come under pressure, with the spot price of U3O8 hovering around 65.25 per pound as of February 20th, 25. Rising interest rates and a general risk-off mood in markets haven't helped either, especially for junior miners like Energy Fuels. Company-specific headwinds have added fuel to the fire. While the firm reported a revenue of $78.1 million in 2024, it also posted a net loss of $47.8 million. This loss was largely driven by acquisition costs and operational expenses. Additionally, there were transport disruptions from the Pinyon Plain mine between August 2024 and February 2025, which impacted production schedules. Ongoing compliance issues at the White Mesa Mill have also raised environmental concerns. Analyst sentiment has softened. While some firms maintain buy ratings, others have trimmed their price targets, signaling caution in the near term. Despite the downturn, there are several compelling reasons why Energy Fuels could rebound. Globally, demand for nuclear energy is rising. With the push for cleaner, more reliable energy sources, uranium is making a comeback. The International Energy Agency expects demand to double by 2040, and new technologies like small modular reactors, SMRs, are fueling this trend. Energy Fuels is well positioned to benefit. It's not just a uranium story. The company is also building out North America's only integrated rare earth production capability. Its White Mesa Mill has begun commercial production of separated rare earth elements, a critical development as the U.S. looks to reduce its dependence on China. On top of that, Energy Fuels boasts a strong balance sheet with no debt and a diversified asset base. It has the unique ability to pivot between uranium and rare earth production depending on market demand. Strategic agreements, like one with Chemours to build a domestic critical mineral supply chain, underscore the company's growth potential and policy alignment. Still, risks remain. Executing on its rare earth ambitions at White Mesa is no small task. While initial production has started, consistent profitability in rare earths is difficult to achieve and will require major capital and operational efficiency. Additionally, uranium spot prices remain volatile. Any decline below current levels could squeeze margins. The company's history of funding through equity raises also brings the potential for further dilution, an issue that existing shareholders may find concerning. From a regulatory standpoint, Energy Fuels must maintain compliance with environmental and transportation standards. Delays or increased scrutiny could disrupt operations. And geopolitically, shifts in trade policy or international relations could complicate the company's access to global markets and technology. Technically, Energy Fuels is in rough shape, but there are some signs of life. The stock is currently trading at $3.45, down 47% year over year. The Relative Strength Index, RSI, is sitting at 29.79, firmly in oversold territory, suggesting the possibility of a bounce. The MACD indicator is still negative at negative 0.20, signaling bearish momentum remains. Resistance sits near $3.95 to $4.07, with the price currently below key moving averages. While a bullish hammer candlestick has appeared, often a reversal sign. Traders would typically want to see the price break above the pattern's high before taking action. Volume has also picked up recently, with over 8.7 million shares trading daily, higher than the 3-month average. Whether this signals institutional accumulation or retail capitulation is still unclear. Analysts remain cautiously optimistic. As of April 20, 2025, the average price target among 4 analysts is $7.81, with a high of $10.75 and a low of $5.75. That's a potential upside of more than 120% from current levels. H.C. Wainwright recently reiterated a strong buy rating with an $11 target, while Roth MKM lowered their estimate to $5.50 but kept a hold rating. Smart Money has shown mixed signals. Recent 13F filings indicate hedge funds have slightly trimmed positions, with Bridgewater Associates notably cutting its stake. However, ETFs like the North Shore Global Uranium Mining ETF still hold a significant allocation in energy fuels, signaling continued institutional confidence. Retail sentiment is holding strong. On forums like Reddit, energy fuels remains a frequent topic among uranium bulls. Users frequently highlight its production capabilities, rare earth angle, and US-based operations as reasons to stay long. This retail enthusiasm adds volatility but also resilience. So where does that leave us? The bull case is simple. Uranium demand rebounds, rare earth operations mature, and energy fuels outperforms. The company's diversified strategy, clean balance sheet, and strategic partnerships give it a unique edge in 2 of the most critical material markets of the future. On the flip side, if uranium prices falter, or if energy fuels fails to deliver on its rare earth promises, the stock could drift lower. Dilution, operational missteps, and regulatory headwinds all remain risks. For investors with a high-risk tolerance and a long-term view, energy fuels might just be one of the most intriguing bets in the clean energy materials space. But it's not for the faint of heart. As always, due diligence is key. So, is energy fuels a falling knife or a future rocket just waiting for ignition? Is this sell-off a screaming buy for contrarian investors or a warning sign of deeper issues ahead? We've laid out the bullish drivers, the bear case, and what the charts and sentiment are telling us. But now we want to hear from you. Drop your take in the comments. Are you buying the dip, holding through the turbulence, or staying far away from energy fuels until the dust settles? And if you love smart takes on market volatility, hidden gems, and explosive stock potential, smash that like button, subscribe to Stocks Telegraph, and ring that notification bell so you never miss our next deep dive stock breakdown. Thanks for watching, and we'll catch you in the next one.